Asia go a little bit lower here on the S&P 500, maybe by about 0.2%. I want to get out to Madhavi Arora, the lead economist at Emkay Global. Madhavi, I was looking through a note by Goldman Sachs, and as a result of the developments over the last 12 hours, they have actually added a rate hike to their Fed forecast for 2023. Are you jumping on the same train? Have you revisited some of your projections?
So, it's just reminding me of what we saw, in early autumn of last year. It's, the consistent repricing that we are seeing by the US Fed clearly shows that there is something which has been missed by the policymakers, by the markets in terms of how much overheating has actually happened. To that extent, I believe, the kind of data that we've seen over the last couple of weeks or so clearly shows that, there is a bit of a good chance that activity indicators will continue to remain strong as we go into February, and market might have to start entertaining a possibility of a 50 bips moves by Fed in March itself. I think it's significantly challenging the narrative of benign tightening of the rates market in this year ahead, and I think it's a good possibility that you probably would be seeing a Fed funds rate, ending the year or probably, peaking at around 5.5 plus or a 5.75.
How much does the world change for you when the peak Fed rates shift higher? I mean, let's say we get, deeper into the 5%, maybe we hit 6%. What does that do to some of your economic views for the U.S.? Does that bring a recession back firmly into play?
So, recession are very strong disinflationary agents. I mean, they generally go hand in hand. You would not have a consistent disinflation or a deflation rather until we have a recession in place. Of course, if the Fed fund rates goes up to a 5.5% to a 6%, you are looking at a really wrecked labor market, because that's what is currently giving you a strength at this point in time for the Fed to be able to raise, up to a 5.5% or a 6%. So clearly, when you look at a policy rate which is entrenched at a 6% plus, I think you are looking at a deflationary trend which is still yet to be seen. Two, a wrecked labor market, which is a long way to go. So I think those two things will be something which will be the ones that Fed would want to break in the first place. And if that really happens, I think to some extent the equity markets who have been sort of talking about a soft landing scenario will have to reassess their numbers, because this point in time, most market participants have been sort of assuming that we are probably going to be having a soft landing, which will have implications for the risk assets across the world. We saw dollar actually losing steam during the end of the year. Now it has come back with a vigor, and we still are, discussing where the end point of the whole game is going to be.
I mean, you talk about the end point. I just need to get your view as well about some of these PPI numbers, because yes, it showed profit margins that remain resilient. I'm wondering though what that tells us about the potential drivers of inflation going forward within the basket of components that ultimately create the full output CPI.
So I think, this time around, we saw actually a broad-based increase in the US CPI. In fact, we saw food, energy, core goods, and even core services, all of them going up. Core goods, which had been leading the disinflationary theme in the US in last part of the few months, has again started to go up. It makes me feel that probably the destocking that we saw, will probably need to be relooked at. You will probably see the inventories normalize, which also will mean that good categories could again go up. We were seeing the used car prices, being elevated in the last few months or so, and I think that category can again rebound and probably, pain the policymakers. On the other hand, of course, shelter costs have been very high. They've been increasing consistently over the last, few months or so, entrenched around 0.8% month on month. I think it'll still take, almost 6 months or so for it to peak and to start showing up as a component CPI, which will start looking to go down. I think these two factors are looking to be a bit of worry for me. Of course, core services overall is strong, partly as the world is still normalizing and you still have an intrinsic demand in the US economy. I think it's a long way to go with regard to where we're seeing the inflation to really come off. We will see it come off eventually, but I don't think it will be a complete journey.
Madhavi, it was massively valuable to get you to weigh in on some of these ideas. As Madhavi Arora, the lead economist at Emkay Global. Thanks again for your time. So much more to come.